Hey guys, thank you guys for joining me on this month's webinar, SIH Capital Group's monthly webinar. As you know, we try to bring in a guest once a month. We don't do this weekly, so we try to focus on quality versus quantity, so we're not doing daily. So I'm really happy. A couple months back, Brian was actually one of the first people I reached out to. Long story short, with Brian, I met Brian at a conference, at the Mid-Atlantic Conference a few years back, and his presentation, when he did it, I was like, oh, this is really interesting, but I didn't understand the significance of it until I started doing my own deals, started doing my own underwriting. And there was a lot of things that I was looking at with all the current models. And I was like, you know what? I kind of still vaguely remember this amazing presentation that Brian gave that kind of says to do it this way and not that way. And it was pretty vague. So I reached out to Brian, I think it was like a year ago. And I was, Brian, would you by any chance have that presentation saved? And he said, unfortunately not. And then I had the great idea to follow up with it and say, hey, Brian, would you ever be interested in ever presenting it? I didn't have the series at that point. And I said, hey, I think my investor base would really, really love this information. Would you be interested in coming on? And he was like, sure. He literally responded the same day. So always super thankful. And I just wanted to share a quick plug for his book. If anybody is into multifamily from an operator perspective or investment perspective, I'm going to share his book on Amazon so you guys can see it firsthand. It's The Hands-Off Investor, Investor's Guide to Investing in Passive Real Estate Syndications. It is one of the best collective pieces of literature that can guide you when you're starting out in underwriting. A lot of times you'll look at a deal and an operator will send you the deal, and these deals look very presentable and they have flashing great returns. And it's not until you could actually dissect some of those numbers that they're using to actually produce those flashy returns that you can kind of justify if this is a good deal or not. Brian's book is amazing because he's got chapters where they're saying, okay, these are the benchmarks that should be used. This is the water expense that should be used per unit. This is the payroll expense. And when you're looking at the presentation, you could actually kind of see, hey, are these numbers lining up to what Brian is saying that they should line up to? And it's amazing how many times that they don't. And that can help you gear your future conversations with that operator. So quick shout out to his book. And one of the best reviews while I was considering how I should introduce Brian is I found this incredible review, and I actually saved it to my Asana. And Brian hasn't even read this review, and it was only a 4-star review, but I think it personifies how significant the book is. So the reviewer actually said, well, rating the book is subjective. Well, every review is. And he said, I give it 4 stars because the author did a very good job presenting the material. There's a ton of great information in this book. It's very comprehensive in terms of the details of syndication, but for me, the book paints a negative picture about syndication. Perhaps there's the author giving us all the negative and risky things to be aware of when investing in a syndication. But I'm completely turned off. With all the metrics, demographics, financials, things to look at, it's hardly hands off. I'm happy to have learned about it, but I won't be investing in real estate and syndication anytime soon. And I just think this is the greatest thought review because I wrote a book on alternative investment. And if someone read that whole book and saying, this is too much work for me, I am so happy about that. Because for $12, they got to make that decision of it's $20. Usually speaking, when you talk to an operator, it's a semi-promotional business where they're talking about how great syndications are. They're talking about all these benefits. When Brian talks about it from years of experience, it's not that. He tells you exactly how it is, and that's why it comes off negative. But anybody that knows syndications knows there's tons of positives there. But the fact that he could paint such a negative picture is, I think, a testament to Brian's knowledge that he can actually paint that picture. And that is exactly the reason why you should read this book. And that being said, I want to pass it over to Brian for him to get into his presentation. And thank you so much, Brian, for being here.
Yeah, Dennis, thanks for inviting me to do this and for sharing that Amazon review. That was actually pretty cool. I love that. That's probably the favorite review I've seen, and I haven't seen that review before, but I think it's great because I didn't write the book to sell syndications. I wrote the book to educate people on the risks of syndication so they can make an informed decision. I think I've told this story 100 times now, but there was a friend of mine. In fact, I even spoke to her on the phone today. friend of mine that had lost her entire life savings investing in a syndication with an operator that later turned out to be a crook. And, you know, and I said, if I could save one person from having to go through this experience, then this book was worth it. And that doesn't mean that it's telling you not to invest in syndications. It's just saying, like, if you're going to do it, which isn't a bad idea, by the way, these are the things you need to look for, and this is how you have to approach it, and this is what you need to look at. So I told her her losses were not in vain. So I don't think that really made her feel any better, but nevertheless, yeah, I wasn't here to hype it. I'm here to educate, and I think people value that more than hype anyway. So today, Dennis asked me to talk about valuing multifamily real estate. I'm going to attempt to share a screen here. Give me 1 second to make sure I get the right one. All right, looks like I made that happen. So he asked me to speak about valuing multifamily real estate. This is a presentation I gave at the Mid-Atlantic Summit a couple of years ago in Philadelphia. This isn't so much on how to invest in syndications, but how to think about what multifamily real estate is worth. And why that's important is because people have a tendency to think about it all wrong. They'll say, like, well, cap rates are too low, so I can't buy, or returns are this or that, or, you know, the seller's asking too much. And there's always like this funny exchange that goes on when talking about valuation of multifamily real estate, where, you know, a buyer always says they got a great deal, and another buyer that didn't get it always says that guy was crazy and paid too much. And you know, I kind of went through that same thing. And so back in 2015, I bought this property. I paid $12 million for it. And everybody was asking me, like, oh, it's too late to find good deals anymore. There's no way, you know, the market's run its course. I think I bought this thing at like a 7 cap. And it was like, people were like, oh, you got to have a 10 cap, or, you know, it's not worth it. And, you know, the market's getting too frothy. Well, in 2020, I sold that deal for a little over 20 million, almost $20.5 million. But while I was holding that property in 2017, I bought this property for $14 million. And again, everybody was like, oh, you know, there's how can you possibly still be finding good deals? It's the market's gone too high. Buyers are paying too much. I think I bought this at a 6 cap. Then in and by the way, sold that property last year for a little over 23 million. And then in 2019, I bought this property for a little over $40 million. This was probably about a 5 cap. And again, everybody was like, well, boy, are you sure that that's not paying too much? It seems awful frothy. Well, in 2021, we sold that deal for 62.2 million. In fact, I did that twice. We bought another 2-pack of properties in 2019 that we sold in 2021 for 65 million. And so the market has had a really nice run up, but how do you know when that's going to end? Well, you know, nobody really knows, but we're going to talk a little bit about how to approach valuation of real estate, and the fact that most of the people that were saying to me that that the market was too frothy and that there was no way I could still find deals, they wouldn't recognize a deal if it jumped out and bit them in the nose. So that's part of the problem. And so, you know, people always wonder, how can you make any money with cap rates as low as they are? You know, they say a 3% cap rate, there's no return. And they're saying that because they're confusing cap rate with investment performance, and those two measurements measure two different things, and they aren't one and the same. So cap rate is not a measurement of investment return. So low cap rates don't mean that you can't make money or that there's no return in the investment. So the problem is most people are approaching valuation all wrong, and that's why they're wondering how it's possible to still find good deals in a market like this. So I'll just go into just a brief synopsis of my background. I've been investing in real estate for about 32 years. Started out in the single family fix and flip space, where I bought houses on the courthouse steps at foreclosure auctions, fixed them up and resold them. Bought over 700 single family homes. About 580 of those were flips, and about 120 of those were rental houses. All of those in California. Well, except for two that were in Florida. That was kind of a little side jaunt that we did, but all the rest of them were in Northern California and San Francisco Bay Area and Northern Cal. Been in the multifamily business now 20 years, bought over 4,000 multifamily units. So in this career, I've bought over $800 million in real estate. Also have a lending company where we've lent over $1 billion. I think we're at about $1.3 billion now lent to real estate investors. So I've had a chance to see how real estate works, both from the operator side, the investor side, and from the lender side. So it gives me a kind of a perspective from all vantage points. In our company, we've been able to accomplish what we have with the help of 1,500 passive investors who've invested in over 40 passive real estate offerings. It's over 250 million raised from those investors, and that experience of having done that is kind of what formed the basis of writing The Hands-Off Investor. Our team here in-house has over 106,000 units of multifamily experience. This is my quote unquote mastermind, and this team is dedicated to our success, and I get to talk to these guys every day and learn from their experience in this business of 20, 30, and 40 years, and apply some of the lessons they've learned as well as the lessons I've learned along the way. Our current operating footprint's pretty much nationwide. We've owned in really probably more states than not. I haven't even colored them all in here. As on the lending side, we've lent in, I think, about 27 states now. So we've seen real estate all across the country and kind of have a good eye on what's going on out there in the market. Again, mentioned The Hands-Off Investor already. Yes, you can get that on Amazon, but you can also get it at biggerpockets.com/syndication book. That's buying directly from the publisher. And if you get it there, you get some bonus content, which includes a question list of questions to ask real estate sponsors and or at least questions to make sure that you've covered through their written material. There's also some interviews on there with other passive investors to kind of hear what they're looking for, some recorded video interviews. So those are kind of interesting. And you get that bonus content if you get the book direct from the publisher. So why do people want to invest in real estate at all, or even multifamily specifically, which is really the hottest asset class right now? Mostly it's just the long-term risk-adjusted returns. Multifamily has the highest returns per unit of risk amongst all property types. I think you've probably seen that in action over the last 2 years with COVID and watching retail and industrial and or at least retail and office go through some interesting challenges along with hospitality properties. Industrial's actually done quite well over the last couple of years, but apartment seems to be the favored asset class right now, and probably will be for the near future. For us, when we acquire, we go through this really intense deal flow acquisition process where incoming leads go into our funnel, where we then, we'll review, say, 500 properties, maybe over 500 properties. We'll pass on most of those really early on. One of our first passes is just simply location, vintage, and size. And this is just a personal thing. Everybody has a little bit of a different tolerance on what they're willing to buy. I've kind of been there and done that throughout all different kinds of properties. So we've really figured out what we like, and that is newer apartment complexes over 100 units in size, preferably over 200 units. Definitely built after 1980, but preferably built after 2000 is really kind of the first funnel for us. And then location, what market is it in? We like to invest in markets where people are moving to and avoid markets where people are moving from. So assuming that they pass all of those first quick check the boxes, we'll dump those into our underwriting queue. Let's say out of the 500 properties, 100 of them make it to underwriting. From that, we'll do a first pass analysis. Maybe 10 of them will pass underwriting, and we'll put an offer in on those 10. And out of those 10, we'll get one property. I'd say that's been our long-term average. I think lately, over the last couple of years, you might double all of that, where 1,000 properties yields 200, which yields 20 offers, which yields one property. It's just more competitive right now. In fact, lately, we haven't even been able to hit or even get close to hitting on anything that's been marketed to the general public. Everything we've been buying lately has been off market. That's been, directly buyer to seller. And that's, we just acquired in December, $150 million portfolio of 3 properties in the Atlanta market, off market. And we got another one a few months ago in the Mobile, Alabama market as an off market transaction. So really that's how we're sourcing most of our deal flow these days. But so how do we figure out how much to offer when we're making these purchases, and what methods do we use? And I'll tell you, first off, it's not cap rate. We don't just take the income and multiply it by a cap rate and come up with a value. That's way too simplistic. So let's start with the basics. The first thing is, how do you figure out the value of a house? And when you're figuring out the value of a house, you're figuring out what the house is worth when you fix it up and resell it, what you're going to sell it for. So, I came from the house flipping business. And so in the house flipping business, the first thing you always want to know is how much that house is going to sell for when you go to sell it. Nothing else is really important yet. The next thing you need to know is what it's going to cost to fix it up, to get it into the condition it needs to be in to capture that price. That's the second stage. And then it's just a simple formula. And the formula basically looks like the ARV, which is the after repaired value, minus the margin, which is how much profit you want to make, minus the rehab cost, which is the cost of construction, and that equals how much you can pay. It's a very simple formula. This has been done thousands and thousands and thousands of times. I've done it over 700 times on single family. And it's a real easy way to buy a house flip. Coming from that background, I learned to apply a similar principle when buying multifamily property. And so it's a little bit difficult with multifamily because apartment buildings are different than one another, and valuing them is not just a matter of kind of running comps and figuring out what those comps are going to be. And you hear this all the time where people are like, oh, multifamily in Atlanta is selling for $175,000 a unit. Well, maybe, but maybe not. You have a 1960s 50 unit property in a bad neighborhood isn't going to sell for the same price per unit as a 2005 built property in a good neighborhood. So if you can't directly compare one asset to another like you can in single family, where you can compare the house you're going to buy to the house right down the street that's the same floor plan, model match, recently sold 3 months ago, you can really get an idea of what that house is worth. You can't do that in commercial real estate. So what do you use? There's cap rate, there's gross rent multiplier, there's cash on cash return, there's IRR, there's comps, there's all these different things. So let's kind of run through, the method that I use, but we'll start with just a brief introduction to cap rate. Cap rate is, some people think cap rate is, I've heard it referred to as the rate of return that you would achieve if you paid all cash for the property. In other words, you buy $1 million property, it has $100,000 worth of income. $100,000 divided by $1 million is 10%. So the cap rate is 10%. That characterization is not true. It's not really truly the rate of return you get if you paid cash for the property, because if you paid cash, you'd still have closing costs. You'd still have renovations that you would have to pay for up front. You might increase the income, so that's going to throw the income up. So that's going to throw off your calculation. So it's really not a measurement of rate of return. Instead, what it's doing is think of it as a thermometer, and it's giving you the temperature of the market. And the higher the capitalization rate, the cooler the temperature. They work inverse to one another. And the lower the cap rate, the hotter the market. So in other words, a 3 cap property would be much more sought after than a 10 cap property, which may sound counterintuitive, but there's reasons for it. And we'll get into that a little bit. So just think of it, just put it out of your mind, the whole concept of of rate of return, and think of cap rate just simply as a barometer or a thermometer for the market. And that's it. Nothing less, nothing more. So this is what people will do, is they'll try to work the cap rate calculation backwards to set their purchase price. So what they do is they'll take the income divided by the cap rate and come up with a value. So they'll say, okay, the income's $100,000. I want to get a 10% cap rate, so therefore the value is $1 million. Then somebody else comes along and pays 2 million, and then the person that did that calculation goes, well, those guys are crazy, they paid too much. Well, what they did is they paid a 5% cap rate. If everybody else in the market is paying a 5% cap rate, they probably paid about market value. So they weren't really that crazy. Maybe they knew something you didn't know, or they knew how to really value the real estate and knew that capitalization rate was not the way to do it. So how do you do it? Let's flip multifamily up on its head, and let's value it like you would value a flip. So what's the first thing you need to know when doing a flip? And we covered this a minute ago. That first thing that you need to know is the exit value. And so in the context of multifamily, I'm not yet saying that your exit value means you have to know what you're going to sell for. But instead, what I want you to think about is what you're going to be able to rent for after you fix these units up. So this is the first thing you need to know. If I'm going to buy this multifamily property, let's say rents are $800. If I put $5,000 a unit into repairing or upgrading these units and making them a little bit nicer, I can get those rents from $800 to $1,000. So my after repaired value, my ARV, so to speak, is the rent that I'm going to achieve after making those repairs. The next thing that I'm going to want to know is what rate of return do I want to get? And so if I'm going to put $1 million into this deal, and let's say I want to earn an internal rate of return of 15%, with those two things, I can determine how much I'm going to pay for the property. Unfortunately, it's not just a very simple math computation. We have to go through a few steps to get from these two basic pieces of information all the way down to the strike price. So question is, are you ready for this? Because we're going to go through a 4-step process of evaluating how to get from just knowing the after renovation rent and the return you're seeking to achieve, to figure out the value that's fair to pay for the real estate. And that READY formula is READY, R-E-D-I. So let's go through the steps of this process. The first one is rents. You have to know how much the rents are going to be after renovation. That's the first thing. The second thing is you need to know the expenses and what the expenses are going to be. And the third thing is you need to know how much the debt service is going to be. And then the last thing is that IRR. These are the four steps for valuing multifamily real estate: rents, expenses, debt service, and IRR. Rents minus expenses gives you income. That's what cap rate is measuring, right? It's measuring income relative to value. Rents minus expenses minus debt service is giving you cash flow. Internal rate of return is measuring cash flow. Cash flow is much more important than cap rate, because cash flow is what really comes into your pocket or into your bank account, whereas net operating income that's just used in the cap rate calculation may never see your pocket if it gets sucked up by debt service. So let's first start with rent. The best way to identify rents is you got to analyze the rent roll and look to see what apartments in that property are currently renting for. You also want to see what the newest leases. So I'll usually break these down into a table. I'll put these into a financial model, into Excel, and I'll get a table of every floor plan in this property. And from that rent roll, I'll be able to break down each floor plan's current asking rent, their effective rent. I'll blow this up a little bit for you. Their asking rent, the effective rent, which means what are they actually getting today on average for each floor plan, newest leases, meaning if they sign a lease today, what's that lease rate going out at? And then the next one is me coming up with a future market rent. What do I think that that rent's going to be after renovation? And it says here year one. It really isn't year one. It takes you 2 or 3 years to renovate a property, but this is the starting point for where you want to start asking rents in year one as you complete renovations or as renovations are completed. So really all we're doing here is we're just comparing one to the other, and we're looking to see, at this particular property, the asking rents were 562, the effective rents were 551, which means that they're currently asking more than on average they're getting for those units. The newest leases, though, on this first floor plan were 565, meaning that they were actually today renting out for a few dollars more than the asking rent. And then we were projecting on this property that when we bought it, we would get rents from 550 to 565, where they currently are up to 675 after doing renovation. This is just a matter of looking a little bit about what the rents are doing here at the property, but also looking at rents in the submarket at other comparable properties. So this was a property that we bought several years ago. So some of these rents may look a little low by today's standards, but you'll use the same practice today where you're going to look at comparative properties in the area and see what they're renting their units for. And then any good real estate sponsor should be visiting those comps and comparing the quality of those properties with the quality of the one that they're buying to make sure that they're comparing apples to apples. But by looking at comparative rental rates at other properties and what the property itself is currently getting, you can get an idea for what you can rent the units for post renovation. And if you're analyzing a sponsor's passive real estate offering, don't be afraid to ask for rental comps or see what other rental properties in the area you're getting to make sure that the sponsor's assumptions for their future rent are reasonable. And I'll tell you one thing that is really, really important is that nothing that the sponsor will project will move the needle more than the projected rent. If they're off, it will have a significant impact on the rate of return that's delivered on that asset, or in one direction or the other. If they came in low, those returns will be astronomically high. If they estimated high, they'll be under their projection. Conversely, expenses, on the other hand, you can be off by a little bit, and you can be off by 10%. It doesn't move the needle a whole heck of a lot, but rents will. So make sure that you're seeing rent comps and that those rent comps make sense and that they're reasonable. So now you can see what we did here is we kind of averaged the property here, and you can see in green the effective rent. That's where the property is now on average, 807. In red, you can see where we plan to take it, which was 936. And so that lift in rents, that's how you add value, is that extra, $129 in or $129 in rent. That's how you're making that property worth more after you buy it than it is today. And that's really where the value proposition is. So how much do you pay for the property? Well, we still don't know that yet. The next thing we have to do is take those rents and project out over the life of the property what those rents are going to be on an annual basis. So we're going to apply a growth rate. In this case, we were just applying a level 3% growth rate. There's times where we'll apply a higher growth rate in earlier years, and we follow guidance from Axiometrics, which is one of the study organizations that looks at rental growth rates across the country and makes projections for future rent growth rates, and we follow their data pretty closely. So now we're using we'll have different rental growth rates for every year throughout the ownership period, but you want to apply those rental growth rates each year to determine what the average rents are going to be over time. And so once you've done that and you've projected what those rental rates are going to be each year for the hold period, and this one we used a 10-year hold projection. Once you've projected that out over each year, using that growth rate. This is just example of that axiometrics data I told you about. We were using, they said we used 3% level rent growth in our model, but here, axiometrics was forecasting, 4.2, 4.6, and 5.1 for those years. So, always make sure that the sponsors are at least being conservative, if not using data supported by third parties, at least they're going less than what those third parties are saying. But once you have those projected out over the life of the property, then the next thing that you're going to want to do is drop those into a model so that you can see what the projected income is going to be each year. So the next thing is we're going to look at the expenses. And the way to start with expenses is you'll get the historical expenses from the property by looking at their trailing 12-month income statement. That'll have a variety of expense categories, and analyzing those prior expenses and breaking those down into something that you can use. We'll put it into an Excel model, and we'll look at the trailing 12-month expenses for each of these various expense categories. We'll also look at the broker's pro forma expenses, which usually are just made up. And then we'll come up with our own expense pro forma. And sometimes what we're doing is we're looking at, if the broker's estimating that a certain cost is going to be higher than what the property's currently been experiencing, we're going to ask why and see if we can find out if there's, something that they know that we don't know, to try to figure out what that first year expenses are going to be. We'll also use expense comps from our own properties to see, we know that our general and admin usually runs around $225 a unit. So we'll apply that because that's the way we operate real estate. We know what our costs are. But we're going to want to look at a side-by-side comparison of the trailing 12-month expenses with our projected expenses and look to make sure that each of those makes sense. So once we've made our first year projections for expenses, just like we did with rents, we're going to apply a growth rate, and then we're going to make a table of income every year. That table of income is going to show, the effective gross income each year, the operating expenses each year, and then the net operating income each year. And by the way, you shouldn't have to do all this legwork if you're investing passively in a real estate offering. The sponsor that you're investing with should be doing this for you and presenting this to you. And you should be able to review this and see these side-by-side comparisons of previous income alongside forecasted income, so you can make these comparisons. If they're not doing that for you, then I'd consider that to be either a red flag or at least a cause for you to ask them to provide that for you so that you can make that comparison on your own.
Brian, can I jump in here for 1 second?
Yeah, go for it,
So
Dennis.
one of my favorite parts in Brian's book is literally there's a chapter where he dissects every single line item on a T12 and will tell you where the red flags are. So example, like repairs and mains, there's an amount times it by the units, and that's what the number should be around the range. It's not exact. So, if you're seeing a T12 and you're seeing a repairs mains number of 52,000, but Brian's book is saying that it should be 100,000, that's a red flag where it might just warrant just a question to the operator. If you really, really love that deal, maybe say, hey, I looked over the T12, the repairs and mains look really light. What's the plan here and why is it thing? The other big thing is from an operator's perspective, I was looking at a deal and it was just clear that the repairs and mains were double what they were supposed to be. And there was an opportunity there. So it works both ways, but the significance of, you can literally apply Brian's book from day one as a passive investor, especially with the T12.
Yeah, that's a great point, Dennis. And I also think, just to add to what you said there, with inflation being what it is right now and labor and materials costs going up, even the numbers in my book might be a little bit light now. But certainly if you're seeing sponsors projecting expenses that are lower than what you've seen in the trailing 12-month past, I'd be especially suspicious of that, given the price increases that we're seeing across the board for just about everything right now. I would expect most costs are going to increase unless there's a good reason why they'll decrease. And there are good reasons why some expenses will decrease. For example, payroll. Maybe they've got too many people on staff. Maybe they're running corporate payroll through the property that should have been on the corporate side. There's a lot of reasons why some expenses might come in less, but certainly if you see sponsors projecting lower expenses on a line item versus what the property's been experiencing, it's certainly cause for question, no doubt. So once you've got this income mapped out, next step is to look at the debt. Talk to, if you're an active real estate buyer, talk to a lender, share these numbers and rent roll, and get an indication from the lender of what loan terms are out there these days. If you're a passive investor, look in the prospectus to see if the sponsor provided you with some debt assumptions. What interest rate are they expecting? What term, what amortization, that sort of thing, and make sure that there's some modeling of the debt service that's going to be expected during the ownership period. So what we'll do is we'll take, our before debt cash flow, which is where, we'll take the net operating income, we'll subtract capital expenditures, which are like ongoing replacements, like reserves for roofs and that sort of stuff. We'll arrive at a before debt cash flow. Then we'll subtract the net debt effect. Net debt effect is interest and principal, as well as anything else that's loan related annual cost. And then that gives you after debt cash flow. After debt cash flow is what you're actually putting in your pocket each year. It's one of the most important numbers that you're going to have in this analysis, is this after debt cash flow. So now we kind of get to the meat of it, where we got to talk about IRR and calculating IRR. IRR is internal rate of return, and this is a measurement of the return, the investment performance that you would expect to achieve. And it takes into account a couple of things. One is it takes into account the cash flows from operations. The second is it takes into account cash flow received from the sale of the asset. And the third thing it takes into account is the timing of those cash flows and how those cash flows are worth more when you get them earlier than they are when you get them later. And this would also include things like refinance proceeds. Basically anything that comes back to you is included in the IRR calculation, as well as anything going out. If you had a capital call and had to submit more capital, those outgoing cash flows are also included in the IRR calculation. So it's a kind of a true way to measure and compare one investment opportunity to another. And the way that you calculate IRR is, first, I'll start with an income statement that we build for the property to see what the income is going to be every year over the hold period. Now, for a 10-year hold, I'm going to need to calculate that income for 11 years. And you'll see that effective gross income here for 11 years. That's my starting point. Then from that, I'm going to have the expenses, which are projected out for 11 years. And then that's going to give me the net operating income for 11 years. And now, why do I need to do 11 years? If I'm going to sell in year 10, a buyer is most likely to give me value for the income they project in year 11. So I'm going to want to use, or I'm going to want to at least know what that year 11 income might look like to compute the exit price of this asset. So next thing is we're going to look at the after debt cash flow. Again, we're looking at, after the debt has been paid, what's that after debt cash flow going to look like? And then we'll come up with this reversion statement. And the reversion statement is where we calculate what the ultimate sale price of the property is going to be. And it looks like in this asset, we were planning an 8-year hold. So in this particular example, on this 8-year hold, we can see the cap rate. We see the NOI for the subsequent year, a cap rate, and then a sale price. Obviously, these cap rates are a bit high. When we bought, this is where cap rates were. Now cap rates are even lower, which means that income is worth even more. From that sale price, we'll still have a cost of sale. The cost of sale generally runs a couple % of the purchase or the sale price. You got to pay off the loan, so you got to subtract the loan balance. If you had any working capital that was sitting in reserve, you'll get that back. So you got to add that back in, and then that'll give you your net sale proceeds. And so that net sale proceeds is that final year cash flow, and that's going to be needed in order to determine the IRR. And so now to get the IRR, we just lay it all out, and we'll put the annual cash flows each year next to each other. And then in the last year, we have the operating cash flows as well as the proceeds from the sale that we got from using those previous analysis of each year's cash flow along with the analysis of the exit. We put all those into a table, and then we can run some calculations on that. And when we run these calculations, we're going to look at, the total cash flow. So we have the total profit for the entire hold period, which is from operations, refinances, and sale. In this particular case, the investment amount was 5.8 million. That's the down payment, closing costs, renovation costs, and capital reserves that were held for extra cash. So let's begin with kind of the first. There's basically a couple different metrics. There's 3 different tests we're going to run here. The first one is an annual cash on cash return. And to get that figure, we're going to take the cash flow each year divided by the cash invested. So we know that like in year 2, we got $401,000. The cash invested was 5.8 million. So it'd be 401,000 divided by 5.8 million is 6.92%. And we can calculate this every year. In the final year there, we have to strip out the cash that was received from the sale of the asset, because it's not fair to include that as a cash on cash operating return. Once you subtract that out, what was left came out to be about a 12.9% cash on cash return. So that's cash on cash return. The next thing you can do, in addition to calculating that for each year, and what you're looking for here is to see, does this meet my requirements? If I got this return each of these years, am I satisfied with that? If you are, you're good. If you're not, you have to pay less for the property. Plain and simple. The next thing is the average cash on cash. This is just taking an average of all those cash on cash returns for each of those years. And again, you have to decide, is that average cash on cash acceptable or not? And if it is acceptable, then the price that you're proposing here is good. If it's too low, you have to lower the price. So the next thing is we're going to look at the equity multiple. Equity multiple is just taking cash out divided by cash in. So in this case, you take the 9.875 million that was received out divided by the 5.8 million that was invested in the deal, and you get 2.7. That's a 2.7 multiple. So 2.7 multiple means if you invested $100,000, you would get $270,000 back. Under this particular investment, with these numbers panned out the way that they are in this model. So an equity multiple is a great quick way for you as a passive investor to determine how much actual dollars you can expect from the investment after it goes full cycle. So if it was, let's say it's a 1.5x multiple, that means if you invested $100,000, you'd get $150,000 back after the property was sold. So equity multiple is kind of helpful if that's what is most important to you. And then IRR is that internal rate of return. This is the comprehensive way to evaluate real estate returns, because it doesn't matter about hold period. It doesn't matter about refinances. It doesn't matter about how much of it was cash on cash versus how much of it was just from the sale. IRR is just taking that investment's internal rate of return, and you can compare that to any other investment's internal rate of return and compare them side by side and see which ones make the most sense, assuming that the assumptions that they use to arrive at those IRRs are sound. So to compute IRR, you do this in Excel. You just enter this formula into an Excel chart, equals IRR parentheses year 0:exit year. And what that means is you'll just put the cell values for the beginning and ending cells in that Excel chart where those numbers are plugged in. And that's going to give you an IRR. So in this case, it was 16.02% IRR. The cash on cash was 9.84%. The equity multiple was 2.7. So, in this case, you're looking at, almost $10 million profit on $5.8 million investment. And that's how you determine whether or not that purchase price is acceptable to you. And if the returns are too low, you have to pay less. That's the only way you can increase returns. Now, just to drive one point home is this deal was a 6.5% cap rate. And you'll see that a 6.5% cap rate, was 9.8 cash on cash, 16% IRR, 2.7% or 2.7x equity multiple. There's no relationship between the cap rate and the actual investment return in this case. So when you see something that's a 4% cap rate, which is not uncommon today, that doesn't mean that you're going to earn a 4% return. Your returns could be substantially higher. You have to walk your way all the way through this process to determine what the returns are going to be. And then determining the value is simply a matter of whether or not you're achieving the returns you're seeking to achieve given the price you're looking to pay. So I've got just a couple more remarks here at the end, but this would be a good time if you have questions, type them in the question box. Dennis is going to be watching that. And then in a minute here, we'll get to some of his questions. So if you have a question, make sure you've typed it in, and then I'll save some time here at the end for that. I just want to make a couple of comments really quick here before I end my remarks, is that not everybody wants to invest in real estate on your own. I think a lot of you guys are passive real estate investors investing in syndicated offerings. There's a reason that you're doing that, and that's so that you don't have to do all this hard work and do all this math and all this other stuff. You want somebody else to do this for you, and that's what passive investing offers you, is the ability to leverage your time by using the sponsor's time to produce all of these examples for you. And so sponsors should be producing these exhibits and showing you the roadmap to achieve the IRR and how they're planning to get there. So what your job is just to evaluate what they're telling you to see if it all makes sense or doesn't make sense. And really that just comes down to making the right choice with what sponsor you're investing with. If you're making the right choice, they should be showing you all these things. If they're not showing you all those things, that sponsor might be the wrong choice to invest with. It's really important to make the right choice. I like to say sponsor selection is critical, because a good sponsor can finagle the best outcome in the face of adverse circumstances, but a bad sponsor can destroy a perfectly good real estate deal, just as in the example of my friend who lost her entire life savings. Just don't let that be you. There's some contact information here for our firm. I'm not Bob Dreer. That's my Senior VP of Investor Relations. But if you are curious to know more about what we're doing here, Bob's a great resource to reach out to, but you can always visit our website at praxcap.com just to kind of learn more about what's going on over here. But Dennis, I'll throw it back to you. Looks like I saved about 7 minutes for questions, which wasn't quite as much as we'd hoped, but this is such a great dialogue that hopefully we can get through those. Any questions you got?
Yeah, and I'll also piggyback on what Brian's saying about there's a lot of deals out there where you will see the 20% IRRs. And the question is there substance behind those 20% IRRs? Because Brian knows for a fact is when you start underwriting a lot of these deals, there's a couple of key variables that you could push, and all of a sudden you get the 20s, or you'll get the mid 20s. But are they doing a rent growth based on 6% versus the data showing that they should be doing 3%? So I always tell investors to be very weary of the 20s, because when I started out, I invested in the 20s and I was lucky enough to get my money back. When I started focusing on operators that focus in on that 13 to 15% sweet spot, that's usually the operators that are no nonsense with their underwriting, that are actually conservative, because the word conservative is really overused. So just to throw that out there, and the importance of selecting that operator is do not get blinded by that shiny IRR number. That number means nothing at the end of the day. It's about the substance that goes behind that number. And you always want to choose that substance. And the only way you're going to choose that is if you could develop some basic underwriting skills where you could see, okay, wow, that's an extremely high earnings growth, or wow, those expenses are really cut down. What's the business plan off of that? So that's really, really important. And now let me get to some questions. We have one from Keith. What are some of the services? What are some of these services like Axio, CoStar, et cetera, cost?
Yeah, they're extraordinarily expensive is the answer. I think a full nationwide subscription to, Axiometrics, Reese, which is now part of Moody's, these things, they can cost you $75,000 a year and up. I think our CoStar subscription is between, $3,000 and $4,000 a month. And as well, we have Axio. So they're not cheap. There's no doubt about it. So as a passive investor, rather than, obviously you can't make it pencil to go and invest $100,000 a year in data. But what you can do is you can ask the sponsor to provide some support, some third-party support for some of their assumptions from these services. And hopefully they have that subscription or access to that data and can share it with you at no cost. So I would approach it from that way.
And Brian, correct me if I'm wrong. Sometimes the big brokerages, the markets and knowledge reps, they'll share that data, especially when it supports their pro forma. They'll share that data with the operator, and then the operator could then share it with you. You just want to make sure that data is supported somewhere, somehow. Right, Brian?
That's right. And yes, brokerage houses can provide that data as well. Yes.
All right. So Devin's next question: do you think rents will continue to increase for the next few years? I guess the most recent numbers have been torpid, and with inflation, my guess would be yes. Brian, what is your take on it?
Yeah, I think so. Obviously there's a lot of things going on overseas right now that I think are concerning, and perhaps that could throw some unexpected twists our way. But, right now we're seeing intense demand. We are seeing intense rent growth. The experts who are charging you $100,000 a year just to look at their data, these are the real experts that have teams of, PhDs that are out there studying this stuff on a day-to-day basis, are forecasting rents to continue to increase at a pretty good clip in many markets. Now, there are some markets that are flat, so it just really depends on where. I mean, if you're looking at Phoenix, Vegas, Orlando, anywhere in Texas, Atlanta, anywhere in the southeastern US, Florida, if you're looking at those markets, yeah, rents are going to keep going up for quite some time. If you're looking at some of the other markets where maybe people are leaving to go to those more preferred areas, maybe not so much. But I don't see the brakes on yet. Although we are seeing some resistance to pricing right now, just a little bit, more than we had, say, 2 or 3 months ago.
Got it. Mark, I think we answered your question. I want to get to Dean's question. So in your example, the $5.8 million was the cash invested and not the purchase price of the apartment, correct? Question is getting to purchase price another presentation.
No, you're right. The 5.8 million is the cash invested. So that's what's important is, we didn't pay cash for the property. So, but getting to the cash invested, it really is about the purchase price. So if you want to get to that purchase price, you're basically throwing a dart at the wall. You're saying, like, if I pay 20 million for this property, how much cash am I going to need to bring to the transaction, right? So first thing is, how big of a loan can I get? You subtract that off. How much am I going to have to put into renovation? You add that on. And so when you've kind of arrived at how much cash you're going to need, now you run all these calculations that we just ran through, and it's going to give you an IRR. And if the IRR is too low, or let's say cash on cash is more important to you, the cash on cash is too low, or let's say multiple is more important to you and the multiple is too low, then you know that 16 or that $20 million price that you threw at the wall is too high. So now you back it off. Well, what happens if we pay 19 million? You run the same calculations. Nope, returns are still too high. 18 million. Oh yeah, now they're starting to come in, but at 17.5, the returns look really attractive, because the price isn't about anything other than being about you. What return are you looking for? If you're looking for a 15% return, you know that you have to make sure that you're paying a price that, given the amount of capital you're going to have to put into that deal, is going to give you that 15% return. If you want a 20% return, you can still do that. Your price is going to have to be a lot lower, which you probably won't get the deal because somebody else is going to be willing to pay higher because they don't, they'll settle for a 15, or the risk that you're going to have to take on is going to have to be substantially higher. And so what that means is now you might be taking on a property in a shaky neighborhood, or have some other kind of risks associated with the deal, which is the reason why you're able to get the deal that at a price that would produce that 20% return.
And Brian, correct me if I'm wrong, during your presentation, you were like, I don't even look at the pro forma, the broker's opinion or the whisper price. Like, I don't give a damn. I run this scenario and I put in the offer based on the scenario. Wasn't that what you said during the presentation?
That's exactly right. And that's exactly how I do it. I ignore all of that stuff. I'm just looking at these numbers, the output of these numbers, the return that gives me. And I'm starting with a price that's kind of like, I'll usually start with a number that's basically like, okay, I know market cap rate right now is 3.5%, let's say. So I'll start with a number that's around a 3.5% cap rate and see how that works. And then I fine tune from there. And so now let's say a 3.5 cap rate is 20 million, and that doesn't give me the returns I need. I start backing off the price until I get to the return that I need. And that's where I've settled on my value.
Great. All right. Next question from John. The changes of the housing over the last 2 years has created more fully furnished apartments. Have you invested in fully furnished apartments? And if so, how do you evaluate those transactions?
I have not. It's funny. One property manager, I have a small personal rental. It's an 11 unit property. And we've got this one unit that's like the best unit in there. It's bigger than all the others. It's a 3-bedroom unit. And for whatever reason, even though the comps for that unit are extraordinarily high compared to everything else in that building, we always struggle to get it rented out. And eventually we get there. But once we get it rented out, if we ever have turnover, it sits vacant for like 4 months while we find somebody else willing to pay that price. So he called me the other day and he's like, I think we should furnish it and put it on short-term rental. And I'm like, all right, we'll give it a try. So it's going to be interesting to see how that works out. But on a large basis, I have not. And generally because just the effort required to manage that is just more distraction than we need. We're about squeezing returns out of deals, but I don't need to squeeze every nickel at the expense of an extraordinary amount of distraction. So to each their own, when you have thousands of units, for me, short-term rentals kind of just get in the way. But for smaller operators who can absorb the brain damage, it might work out really well. Got
it. And Brian, correct me if I'm wrong. A lot of times you hear on podcasts, they're like, oh, we'll take 5 of the 50 units and we'll put short-term rentals. And usually that's a really bad idea because long-term tenants do not want to see changing faces next to them over and over again. So it's kind of like, if you're going to go with that strategy, it's like all or nothing. You decide to either do a whole like complex or a whole section of that complex, or you don't do the short-term rentals mixed in with the long-term rentals.
Yeah, we haven't, and we've considered it before. I can't say we didn't think maybe it was worth a try at a couple of junctures, but we never did it, and probably never will. And it's just for us, it's just a distraction.
Got it. Okay, next question. And Brian, I know we're a little bit over. You're okay with doing a couple more quick questions?
We're good.
Okay. Robert asked, given inflation and other economic issues and the long-term time to a projected exit, how do you evaluate if the exit cap ratio that is used in the underwriting is conservative enough?
Boy, that's a great question, Robert. And it's a tough one to answer because exit cap rates have an extreme amount of influence on the projected exit value of the real estate. So this really is a meaningful measurement, and it's very difficult to pinpoint. It's a little bit art and a little bit science is about the best way I can put it. And so I'll tell you how we do it. I look at where cap rates are today. I'll add a little bit, and then we'll grow it every year. So let's say right now cap rates are at 3.25%, which, believe it or not, we're seeing that in some markets for nicer assets. So I would start at 3.5, and then I would walk that up 0.1% per year during, the hold period to bring that cap rate deflating upwards. That may or may not be enough. And right now, gosh, I did the same thing 3 years ago and cap rates went down. So I've always been wrong on this, but I've always been wrong in the favorable direction, where it's always been like we got a better cap rate than we thought. It's tough to figure what might happen given, some of the geopolitical uncertainty and other various things that are going on in the world, what's going to happen to cap rates. But I'll tell you, even after COVID was a big shock and cap rates went down again, I still think they're going to go up. I've said they're going to go up for, I don't know, 5 years now, and I've been wrong every time, but I still think they're going to go up. By how much is anybody's guess, but you can never underestimate, or I should say, you can never overestimate how far they might go up. I would err on that side of caution when possible, but it's very difficult.
Got it. And just a quick follow-up to the inflation question. I know when we met at the Mid-Atlantic, you kind of had that sweet spot of 3 to 5 year hold, especially 3 years, because I remember you had that IRR chart where that really maximizes the IRR of a deal if you kind of go in and out to 3 years, because the heavy value add is created during those first 3 years, and then it kind of levels off. Has your perspective on that changed with inflation? Because my deal, the fact that I could get, debt below 4% in this inflationary environment, I want to stretch that thing out as long as possible. Has that changed your 3-year timeline? Has inflation changed your 3-year timeline to maybe 5, 7, 9 years on the deals you're underwriting today?
Well, it's changed it, but not in the way you might think. I mean, instead now we're, we bought a deal, I think 18 months ago, and we're going to sell it. So, we're actually selling stuff in 1.5 to 2 years instead of 3 to 5 because of that inflation. We've seen a major move in multifamily prices over the last probably 8 or 9 months. And we're harvesting those gains. I mean, I always like to say you can't go broke making money. So we're actually taking chips off the table and selling. We sold 1,800 units last year, and we're going to sell 2 more properties here in the very near future. And those are properties we just recently purchased. So I'm all about, harvesting gains, but we're also looking at stuff that we literally just bought, like we just closed on that $150 million deal in December. And, we're not going to sell that in 1 year, I don't think. That's probably going to be a full 3 to 5 year hold for 2 reasons. One is I think that we're going to see potentially some shakeups in the market over the next couple of years. So I want to get through that and kind of get to the other side before we sell. And the other is if this inflation does happen to continue, then maybe we'll see a run up in value, during that period. But what we're seeing in the market right now, just kind of why we're selling some of these assets early, is buyers are in such a frenzy to buy right now. We're actually able to sell properties today at tomorrow's prices because people are bidding against each other and paying what they should pay next year or the year after now just to get in. So if they want to give me 2 years of appreciation without having to take the 2 years, I'm going to take it.
And have you redone the way you structure the debt on these deals then to have, I guess, less prepayment penalties and, stuff like that?
No, I don't do prepays. I don't do prepays. We finance everything that we buy. This could change in the future, but right now we have and will continue to finance everything we buy on agency floating rate debt. So these are Freddie Mac and Fannie Mae loans that go for 10 years, but I can fully prepay at any time after the first 12 months at no penalty other than just a 1% exit fee, which is de minimis. So we don't do the fixed rate debt with the prepay. I mean, geez, we just closed a $100 million loan. If we did that on a fixed rate with a prepay and we wanted to sell in 3 years, we would probably pay a $10 million prepayment penalty. I would rather that $10 million goes to our investors. So right now we're not using that style of debt. That could change in the future if I see the market slowing down and interest rates increasing in the face of a slowing slowing rent increases, I might shift to fixed rate just because I'll know I'm going to have to hold this for, 7 or 10 years. That's different. But I like to let asset strategy dictate when I sell, not financing strategy dictate when I sell.
Great point. And I think this is our last question. John, it's a two-part question. First part was, what are the best things operators can do to prepare for a correction or crash? And what percentage of operators do you think will make it through the next market cycle?
Okay, so the first part, what can the operators do? This is a great two-part question because they actually relate to one another. So the thing that operators can do to prepare for a correction or crash is not borrow too much. When I was buying foreclosed real estate in like 05, 6, 7, 8, 9, well, I guess maybe not as much in 05 because the market hadn't crashed yet, but when I was doing it in 9, 10, 11, 12, 13, all the stuff I was buying, the loan balances were more than the real estate was worth, and the banks were writing it down and taking losses. These people were losing properties in foreclosure because they had too much debt. So the thing that an operator can do to prepare for a crash is don't over leverage. This $150 million deal that we just bought, we have, $95 million loan. We've got, 33% equity day one, plus all of our renovation costs are paid in cash. So we're actually going to have about 40% of the total deal size in cash, only 60% financing. So don't overfinance. That's the one thing you can do to prepare for a crash. So that's priority number one. And then in terms of what operators will make it through the next market cycle, that depends on when the market cycle happens. If an adverse market cycle hits us in like 1 year, maybe 2 years, and it lasts like 1 year, then not many will survive, because lately, over the last probably 1.5 to 2 years, it seems like almost everyone I hear about is buying properties using bridge debt at 80% of value plus 100% of renovation. So they're at 80% to cost, maybe 90% to purchase price, just a massive amount of leverage. Those loans are going to be due in 3 years. They might have extension options for 2 years if you qualify, which if the market goes down, they won't qualify, and those loans are going to come due. If there's a downturn, when those loans start maturing, those operators are not going to survive. There will be very few of them that survive. And, I will hope to be there to sweep up the glass from that collision, because that's going to be a fun time for me. That's really where we've done the best work in our business has been during times like that. And I look forward to that opportunity in a way. I mean, another way I don't, because that means if I own real estate, then I'm not doing that great either, but at least our financing is low enough. We're going to survive and get to the other side. If that crash happens, 5 years from now, then my answer might be different. It depends on how people are financing their acquisitions, how much time they have, how much their debt load is, and what their interest rates look like when that crash hits. So, again, if it happens early, these guys are going to be caught with their pants down, unprepared, and there's going to be a lot of hurt out there.
There's this white paper that I read when I first got into passive investing, and it was talking about the 07 to 09 crash, and like the statistics that were of the defaults that were done with agency debt, it was like less than 1%, but the bridge debt at that time was like 8.9%. So it was just a huge difference of the right type of financing. And I think that also goes with John's first part of what are best things operators can do to prepare for corrections today. And I actually tell all my passive investors, and this is nothing against bridge debt, I personally, as a passive investor, I don't invest anything right now that has bridge debt. And there is some bridge debt that is kind of like a hybrid these days, but if it's classical bridge debt that expects 2 years and for them to get out at a certain higher valuation, I stay clear from those deals. I'd rather go, fixed or agency or some kind of version of that. It's just so much safer in today's, just uncertainty that you're looking at with inflation and everything like that. I did also want to, I think Rob had one question he just snuck in. Do you buy interest rate swaps on your variable rate loans?
We buy interest rate caps. We don't do swaps. We do an interest rate cap. Yes.
Oh, I think that's it. I don't see any other questions. and I know I kept you 15 minutes past the time, but I think this was great. I really appreciate your time. I think a lot of people got a lot out of it. This is definitely one of those presentations. I will send out the replay, and I know when Brian is going over it, it just seems like it makes sense. And then like you close this webinar and 20 minutes later, you're looking at a different deal. And you're like, oh, you know what? Let me replay that webinar. This is one of those that, you know, save it, watch it, and maybe watch it a couple of times. Read his book, and a lot of the stuff is gonna start, you know, clicking when you do 2 and 2 together. Dean said, thank you. Thanks, Brian. Love your book. It is helping me learn quicker. Brian said, very valuable. Thank you so much for sharing. Agreed, great book. So I think you got a bunch of fans here, Brian. Thank you so much for, you know, checking in, and appreciate your time.
Thanks for having me on. I really appreciate it.
Take care, Brian.
You too.